What does it really mean when we say prices are going up? Imagine you're at your favorite cafe, and last year, a latte cost you $3. Fast forward to this year, and that same latte is now $3.30. This increase isn't just a random change, it's inflation in action. Inflation is the rate at which the general level of prices for goods and services rises, which means your money buys less than before. But why does this happen? Think of prices like a balloon. When you blow air into it, the balloon expands, representing the increased prices of goods and services. The more air you add, the more difficult it becomes to hold onto that balloon without it slipping away. This is similar to how inflation erodes your purchasing power. If you had $10 last year, you could buy 3 lattes and still have a bit left over. But now, with inflation taking hold, that same $10 only buys you about 2.5 lattes. Here's the surprising part. Inflation doesn't just happen because prices seem to go up. It's often driven by factors like increased demand for products, higher production costs, or even government policies. For example, if more people want to buy lattes than there are available, the cafe might raise prices. Similarly, if the cost of milk or coffee beans increases, that's another reason for prices to rise. So when we talk about inflation, we're really discussing how the value of our money changes over time and the impact it has on what we can buy. It's like a slow leak in your wallet, gradually letting your savings slip away. Have you ever watched a balloon being inflated? At first, it's small and tight, but as more air fills it, it stretches and expands. This simple analogy helps us grasp the mechanism of inflation. When more money enters the economy, it's like adding air to that balloon. The size grows, but so do prices. Imagine a local bakery. They bake 100 loaves of bread every day. If their neighborhood has $100 circulating, each loaf might sell for $1. Now suppose they get a sudden influx of cash. Maybe a new tech company opens nearby, pumping money into the community. Suddenly, there's $200 in circulation. More people want that same loaf of bread. With twice the dollars chasing the same amount of bread, the price naturally goes up. Maybe now, that loaf costs $2. And here's the surprising part. This isn't just about people throwing money around. It's also about the perception of value. When everyone has more money, they feel richer and are willing to spend more. This increased demand pushes prices higher. But inflation isn't just about demand, it can also be about supply. If the bakery can't keep up with the increased demand due to limitations like ingredients or oven space, prices will rise even faster. This tug-of-war between how much money is available and how much stuff we can buy is at the core of inflation. So when you hear that inflation is up, remember that it's like that balloon expanding. More money in the system can mean higher prices for everyday goods and services. It's a fundamental reason why inflation can eat away at your savings over time. Understanding this mechanism is key to grasping how inflation impacts your finances, and why it's crucial to keep an eye on it. Vocabulary: inflation, mechanism, demand, supply. What are the different types of inflation, and how do they impact your savings? There are 2 main types of inflation: demand pull and cost push. Think of demand pull inflation like a crowded concert. Imagine your favorite band is playing, and everyone wants to grab a ticket. As demand surges and available tickets dwindle, scalpers start charging more. That's demand pull inflation, when the desire for goods and services outstrips what's available. Prices rise simply because so many people want what's not easy to get. Now here's the surprising part. This isn't just about concerts. It can happen in the overall economy too. When consumers feel confident and start spending, businesses can't keep up. They raise prices to balance the scales. This inflation can erode your savings, as the money you set aside buys fewer goods over time. On the flip side, we have cost-push inflation. Picture a bakery that suddenly faces soaring prices for flour and sugar. To maintain their profit margins, they raise the prices of their pastries. This scenario shows how rising production costs can ripple through the economy. When businesses start charging more due to their increased expenses, it leads to inflation that's less about consumer desire and more about rising costs. So, whether it's the bustling crowds at a concert or the rising costs of ingredients in a bakery, Both types of inflation can eat away at your savings in different ways. Understanding these mechanisms helps you grasp why your money doesn't stretch as far as it used to. Keep that in mind as we dive further into how inflation really affects your finances. What happens to your savings when inflation rises? To put it simply, the value of your money decreases. Imagine you have $100 today. Now, if inflation is sitting at 3%, that same $100 will only buy what $97 could a year from now. That means your savings are effectively shrinking. Think of money like a balloon filled with air. When inflation rises, it's as if someone is slowly letting the air out of the balloon. Each year, that $100 you have isn't just sitting there, it's losing its ability to buy the same amount of goods and services. This is a critical concept to grasp, because it reveals why simply stashing cash under your mattress, figuratively speaking, can be detrimental in the long run. Let's break it down further. You might think, I have $100 saved, but with inflation, that $100 loses purchasing power. This means that the things you want to buy, like food or gas, become more expensive. For example, if a loaf of bread costs $3 today, next year it might cost $3.09 due to inflation. So while you still have that $100, it doesn't stretch as far as it used to. And here's the surprising part. It's not just about the price of individual items. Inflation can ripple through the entire economy, affecting wages, investments, and even interest rates. If the interest you earn on your savings account is lower than the inflation rate, you're effectively losing money over time. So in a nutshell, inflation eats away at your savings by reducing the purchasing power of your money. Keeping your funds parked without considering inflation is like watching your balloon slowly deflate. Understanding this can help you better plan your finances in a world where prices are constantly shifting. What if I told you that the history of inflation can be seen as a roller coaster, with some of the wildest rides happening just a few decades ago? Take the 1970s, for example. This decade was marked by soaring inflation rates, and it changed the financial landscape for many people, often in shocking ways. Imagine waking up one day and finding that the money you had saved was no longer enough to buy the same groceries or pay for the same rent. In the US, inflation peaked at around 13.5% in 1980. To put that into perspective, if you had $1,000 in savings back then, after 1 year that money had the purchasing power of just about $870. That means effectively you lost over $130 in value just by holding onto your cash. And here's the surprising part. This wasn't just a temporary spike. People were forced to reconsider their long-term saving strategies. Many turned to investments, hoping to keep pace with inflation. But not everyone had that luxury. For those living on fixed incomes, like retirees, high inflation meant a serious pinch. Their savings simply couldn't stretch far enough. This historical perspective reveals a critical lesson. Inflation doesn't just nibble at your savings. It can devour them over time. Policies enacted in response to these inflationary periods have shaped how we understand and manage our money today. So, when we look back at the 1970s, we see that inflation is not merely a statistic. It's a real force that erodes the value of money and affects lives. Understanding this history helps us grasp why inflation is such a crucial factor for anyone looking to maintain their savings in the future. What can you do to protect your savings from the relentless grip of inflation? It might seem daunting, but understanding the mechanics of inflation is your first line of defense. Think of inflation as a slow leak in a tire. If you don't address it, eventually you'll find yourself struggling to keep up, whether in your daily expenses or worse, your savings. Let's break this down. When inflation rises, the purchasing power of your money decreases. For example, what used to buy you a full grocery cart now barely fills half of it. But here's the surprising part. Knowledge and strategic planning can help you combat this issue. One common approach is investing. Instead of letting your money sit in a savings account where it earns minimal interest, often less than the inflation rate, you can consider options like stocks or real estate. Historically, these assets have shown the potential to outpace inflation over time. Think of it as planting a tree that grows taller and stronger, providing shade and shelter against the harsh sun of rising prices. Another strategy is diversifying your investments. By spreading your money across different asset classes, like bonds, commodities, or even inflation-protected securities, you can create a buffer against inflation's impact. Each of these tools works differently, like various instruments in an orchestra. but together, they can create a harmonious defense against the erosion of your savings. Remember, knowledge is your most powerful tool. By understanding inflation and making informed choices, you can better position yourself to protect your hard-earned savings. If you found this discussion enlightening and want more insights on navigating the financial landscape, you know what to do.